Okay, welcome back. The markets markets actually come up. So you look up and you look down, you look up again, and things have changed, right? That's the market for you. And as I was saying this yesterday, if you have a bullish view, bearish view intraday, most likely both views will be right several times in the day. But at the end of the day, not very much to show for it.
I think, Prashant, the market has a correlation with your neck movements. Would you want to try that? The minute you look up, look down, maybe the Nifty moves.
I'll backtest it. All right, the Nifty Bank, though, I think let's just have the Nifty Bank up. I think it's, doing better. It's in the green, but there has been significant recovery on both the Nifty and the Bank Nifty from the time that we saw that sell-off, the initial sell-off, which was worth 90 points. All of it has basically been recovered. Almost a copy of what we saw yesterday. Yesterday, we saw a decent, good open, which we did not have today, but then we got the same sell-off like yesterday right after open, and then like what we're seeing, we have a 80-90 point recovery. So, I guess the next acts follow. Well, let's get some market trends going. Pramod Amte is head of research at Intred Equities. He's joining us right now. Pramod, good to have you with us here. Good morning. Do you have coverage on the asset management space, Pramod, at Intred?
Yeah, we have AMC coverages. We cover all the three AMCs.
Oh, wonderful. And have you been able to assess what is the impact of the changes to debt mutual fund taxation for AMCs?
No, I think we are yet to come back on that. But I think structurally, if you look at the regulations have been pretty tough on the industry, right? So as a result of which, we are looking at companies which are gaining market share or where the valuation comforts are much more better. So we are more inclined towards the UTI and the Aditya Birla AMC as the ad ratings on those sectors.
Got that. So let's just kind of then put the spotlight on where do you find solid opportunities, right? Slightly overweight to the benchmark or slightly underweight to the benchmark, but real opportunities now after the correction we've seen, Pramod. Because that is what is relevant for our viewers. On an absolute basis, what do you think is the place to be in? Go on.
So if you look at, you're right, there has been a consolidation or a correction, and hence the valuation comfort for the broader indexes are coming through. In terms of just to draw your attention, we also recently hosted corporates where the comfort is coming through for us on our themes of housing and infra. Both these sectors continue to get the incremental data points support by both the government policy action in the budget or even the micro data points which are coming on these two sectors continue to favor. So as a strategy point of view, these two sectors we are clearly pushing through as thematic. And in terms of the sector-wise overweight, we are overweight on autos, cement, consumer electrical, defense, and the financial services and infra. So those are the large areas where we are more comfortable on overweight.
Okay, Pramod, hi, morning. So just a further question on financial services. There's so much going on, right? First of all, we're seeing all this selling because of over ownership. And the moment funds need to redeem, you end up selling banks by default. So what part of it would you put incremental money in? Private sector banks, PSU banks, or would you look at, let's say, life insurers where prices have been beaten down, or now asset managers because of the latest headache that they seem to be grappling with?
So we are definitely positive on the private banks. Axis Bank remains our preferred pick in the sector, followed by other private banks, ICICI and the HDFC. So other than that, if you look at insurance space, we are still cautious as even the recent regulations have not been so favorable for them. And as I said, AMCs, the regulations are still pretty stricter. So the broader trend in terms of credit growth continues to favor. Some of the private banks are still putting in place to gain the market share. So those are the two themes which will continue to play in the banking space to remain overweight on the space.
Okay, got that. I just want to quickly get your view on the life insurance space, if you have, because that's, it's been for the longest time since I started covering market. It's been referred to as the sunrise sector. Now we have so many of these companies listed, and for the last 3 or 4 years, it's been pretty tough. The industry was hoping for some relief to the budget changes which were proposed, but nothing has come. Any views at all here, Pramod?
No, I think structurally, see, this was supposed to happen, right? These are the tailwinds which were initially given for this sector to achieve the required penetrations. And now I think government is making the right moves in terms of raising the challenge for this sector. I think in the short term, there might be the correction, or the sales teams have to reorient themselves to come back and sell the hardcore insurance products, because easy selling seems to be done and behind us. And that's where there is some amount of deviation, or some winners will emerge versus the tailwind which people are expecting. So our preference is more on SBI Life over the others in the space.
All right, Pramod, thanks a lot for joining in and giving us your thoughts on various sectors, as well as asset allocation on the whole. Rather insightful. We will keep chatting with you. But let's move on to an individual stock which was in focus on our radar on account of a large trade, or rather a large order that it won. Sonata Software is the one. It signed its largest ever contract with a total contract value of $160 million with a US-based consumer retail company. The stock is lower today, but has been buzzing around on the back of this news itself. We have with us Samir Dheer, who's CEO at the company, joining in. Thanks a lot, Samir, for joining in. Just wanted to know, is this a new deal for you, or is it a renewal? Secondly, does this contract of 10 years mean that the revenue is split across those 10 years equally? And how soon does it start to reflect?
Yeah, hi, good morning. So yes, this is a net new deal for Sonata. It is the largest ever contract that we have signed of 160 million for 10 years. This is not an existing client. This is a net new client and a net new revenue for us for modernizing their IT infrastructure for their entire IT. And in terms of the revenue cycle, it will start pretty much immediately, as early as April, and then 10 years from there on.
Is it equally spread over the next 10 years? How does it work?
I think it's by and large spread equally over the next 10 years. Of course, there is some productivity elements involved in the course of the years, but it is by and large set up pretty equally spread out in the next 10 years.
So you roughly get about $10 million per quarter from this, right?
This is 160 million for 10 years. So yeah, so you can, it's about 20 million. Yeah, so you can do the maths from there. Yes,
$4 million per quarter. Sorry,
$4 million per quarter. Yeah.
Samir, so just wanted to understand, since this is such a large contract, what kind of pricing does it fetch you? Margins, pricing, and with that, I mean, I just want to ask a broader question about the pricing environment in the international markets, in the US markets, given everything that's happening.
Yeah, no, so I think we're pretty excited about our proposition for modernization is really resonating with our clients. I think we talked about this to you guys earlier as well. I think clients are looking to modernize their infrastructure, their application landscape, movement to cloud, data modernization, and all this is in part of the engagement that we have, or contract that we just won. So in terms of the pricing, it is in line with the Sonata average. Of course, the first couple of quarters we are going to be doing transition, etc. But beyond that, it will catch up to the Sonata average profit margins.
Okay, so it's in sync with your margins. While obviously you were negotiating this deal and conversations that are happening, just want to understand if there is any hint of hesitancy, any deferrals that people are talking about, just in terms of investing into their IT architecture, given the kind of turbulence that we are hearing of in the US.
Yeah, I think our value proposition continues to be very strong. Like we said earlier, we are not seeing any significant headwinds at this point in time. Of course, there are some pockets for a few customers here and there, but by and large, the growth trajectory is very secular. And this deal closing out at this point in time in our favor is an example of that. We'd had a very stiff competition to win this bid, and we're very excited and delighted that our teams could get this deal home.
No, got that. Now, I think you have an aim to get to $500 million in revenues over the next 4 years, right? Samir, if you got the number correct?
That's right. That's what we'd articulated. In the next 3 to 4 years, we want to double our international services business, yes.
Okay. And that from what you've guided includes about $100 million to be spent on acquisitions.
We did not guide anything on acquisitions. We just said we want to double the company, the international business, in about 3 to 4 years' time, and we're well on a trajectory. I think the Quant Systems acquisition we announced a month back is going very strong.
I'm sorry. I think what you meant is to scale up acquisitions to the $100 million level. Is that what the thinking is?
No, I don't think we've said that either. Let me just rephrase it. What we had said was that we want to double the international service business in 3 to 4 years' time, and we're very consistent with our approach and our strategy to get to that point, and very, very bullish about that. As far as the acquisition is concerned, we announced Quant acquisition about a month back. We are very well pleased with the progress we are making on the acquisition, the integration, and the pipeline build with Quant teams. I think we're making good progress on that front as well, in addition to the largest contract we just announced.
Right. Samir, just 2 points before we let you go. We're running a little short on time. One is that your margins are at a 6-quarter low. Have we seen them bottoming out, or do we see some more pressure there? Secondly, on the Quant Systems acquisition itself, will the integration happen, or has the integration happened? Do we see an additional revenue bump up in the 4th quarter on account of this?
Yeah, so Quant System will have some marginal bump up in the current quarter because the acquisition got closed in March. So we'll see 2 to 3 weeks of revenue come into this quarter. And as far as the margin is concerned, I think our margins are pretty robust. We have always maintained that we want to be a low 20s EBITDA company from an international business perspective, and that's the trajectory we are on. And we want to sustain the trajectory go forward as well.
Okay, Samir, we'll leave it on that note then for this morning. Thanks very much for stopping by and giving us some details on the business and that big order that Sonata Software has won. We'll take a break on that note. On the other side, we take it back to the big headline of the day. Not just the mutual fund amendments. I mean, today is the day we'll have amendments, across the board for the finance bill. Insurance, mutual funds are the big talking points. Dinesh Kanabar, CEO at Dhruva Advisors, joins in with some thoughts. Welcome back. Well, we're dialing back to the big story of the day. Amendments to the finance bill will be discussed and cleared in Parliament. We thought it's going to be more about life insurance and whether that sector gets a relief or not. Well, move aside life insurance. It's about mutual funds now. That's the big headline. Mr. Kanabar is now with us to make sense of things. Mr. Kanabar, as we were discussing in break, the equity market anyway isn't giving any returns. People aren't making money. And now looks like the government wants to make debt unattractive, at least debt mutual funds, market-linked debentures. So what's left?
So first, let me begin with a general proposition that ordinarily when the finance bill is moved, there are, say, 20, 30, 40, 50 amendments proposed to the Income Tax Act. Representations are made, some of these are considered, and when the finance bill is moved to be converted into an act, some of those representations are accepted and changes made to the finance bill. What we are now seeing is a new tendency, and this has been there for the last few years, where totally new proposals are supposed to be introduced in the Finance Act. Of course, we haven't seen the Finance Act. There is something which is doing rounds, and I'm not too sure whether it is authentic, not authentic, because ordinarily the finance minister will move the amendments and it just gets passed. So we are all seeing what's doing rounds on WhatsApp, and I'm presuming for a moment that that is authentic. But you are right. What we are now seeing is new amendments being proposed at the time of moving the Finance Act. And one of those amendments seems to be that debt market funds will be treated on par with MLDs. So the proposition seems to be that if you have a debt instrument, then the entire income should be taxable. There is no question of long-term capital gains. There is no question of indexation. And should this amendment go through as it is likely to, then we are going to see both MLDs and debt market funds sort of not being the preferred things and therefore not having any tax advantage. And therefore people will evaluate a fixed deposit with a bank, a fixed deposit with a company, a debt market fund, everything on par, and sort of not factor any tax advantage in any of them.
That's fairly put. But, to the earlier point, I was also wondering this morning, usually, over the years, the finance bill comes with the budget. There's lobbying, representation made. If there are any changes, they're made. The bill is passed, and then one is scurrying to kind of look through in terms of are there any changes. But here, and of course, one just hopes that this is, of course, authentic. It seems like it. We've spoken with industry representatives, etc. as well. Mr. Kanambar, just in terms of post-tax returns, we had somebody in the morning saying that debt schemes will still be a little more attractive as compared to bank FDs. Any thoughts at all there in terms of how to think about that?
I really don't know in what form and shape. So two things. First of all, the new amendment is supposed to come into effect for purchases made after 1st April. So current ones continue to enjoy that benefit. And probably the way we saw in the case of luxury segment of housing, where people rush to buy high cost homes to shield capital gains, we might see people scurrying to buy debt market funds before 31st March because they will continue to be grandfathered. So that's one advantage I see. Otherwise, whether you are taxed... Yeah, and there is one other advantage which I must bring out, which is a very interesting advantage. If you make short-term capital gains, then the question is, are you still entitled to deductions under Section 54 and 54F? Because both 54 and 54F, even though there is a limit of 10 crores, if you have held an instrument for more than 3 years, then it is a long-term asset. And although for tax purposes, you may tax them as short-term capital gains, if you reinvested those gains in a house and you fulfill the other conditions, then you would not have a challenge. So that in that sense, it could be an advantage out there if a person doesn't have 2 houses and is wanting to buy a new house.
Mr. Kanambar, I think what Prashant was also alluding to, we had a gentleman earlier on the show who was perhaps suggesting there was some math that at least they were looking at, that apparently from debt funds, if you withdraw, I think the interest component quarterly or something on those lines, then there is, then you can, to an extent, it's more tax friendly, but I'm not sure if how that math works. But a larger question. So apart from pure equity funds, where mutual funds hold more than 35% in equity, what other category of an investment product enjoys indexation now? I think there are these RBI bonds, the inflation bonds, but the whole concept of indexation, that gets diluted, right then?
Yeah, so I think in some sense what the government is saying is that whether it is LIC, whether it is whatever you are getting, you are making investment decisions on the basis of the returns that you perceive you will get rather than any tax advantage. And therefore, in some sense, the tax advantage which remains is only on equities and nothing else really.
Yeah, we're talking about a rationalization in the capital gains regime in the budget. It didn't happen directly. I don't know if this is some sort of indirect way of doing it, but it's definitely a shock to the system. But just again, purely looking at it from an investor's point of view, listed equity, unlisted equity, bonds, the entire regime, it was always a very confusing regime, short-term, long-term, indexation or no indexation. So where do we really stand?
So today what remains really, and leaving out RBI bonds and things aside really, today all that we are looking at is equity, whether listed or unlisted, and we are looking at everything else being treated or taxed fully, whether as interest income or as short-term capital gains. But really your only tax advantage comes in on the gains, and indexation comes in respect of long-term capital gains, which you make on equities, whether it is listed or unlisted. There will, of course, still be a few other things which will continue to apply, and that's not going to make things very simple. So, for example, there are tax treaties, and while Mauritius and Singapore have been undone, there are few treaties still where you could get advantage, whether it is in terms of interest rate, whether it is in terms of characterization, those will continue. But, and I know that you are looking only at equities and whatever else, but I must also tell you that there are other changes which are supposed to have been brought about which again, to some extent are shocking. So, for example, we have taxation of royalties and fees for technical services, which suddenly is proposed to be enhanced from 10% to 20% for non-residents. So it's quite interesting the way the government is going about treating things.
Sorry, these are fresh amendments, Mr. Kanabar? The ones that you mentioned?
That's right. So,
sorry, could you repeat that? Could you repeat very briefly the top 2 or 3 other amendments which we may have missed? Go on.
Yeah, I will. So one is that under the Income Tax Act, if a non-resident earns royalties or fees for technical services, then the rate of tax is 10%. That was brought down just a few years ago to realize that, yes, India needs a lot of technology. When that technology comes in, the guy who is supplying the technology wants the fees, net of taxes. Therefore, if you increase taxes, it actually increases the cost of the person acquiring the technology because he has to remit on a gross basis. Now that 10% is suddenly being pushed up to 20%. So again, people will have to go to take advantage of tax treaties if the rate is lower, because in most treaties, the rate is either 10% or 15%. So again, either you will go to 20 or you will have to go to tax office, apply for a lower withholding, tax residence certificates, the cumbersome thing. All of those will continue. That's one thing. The other thing is in respect of offshore banking units in ISFC. So in the gift city. So there again, the original thing was that 50% of their first 5 years, 100% of the income was tax-free. Next 5 years, 50%. There's now proposed to be made 100% tax-free for 10 years. So a number of changes being brought about really. And of course, as I said, these are all what is there in the public domain. I don't know whether these are actual changes happening or not, but these are the rumored changes.
No, we'll have you, Mr. Kanabar here. We are a little short on time, but these are very important other changes you are telling us. So request you to join us a little later in the day as well to explain these to us, to our viewers. Thank you very much for joining us right now, Mr. Kanabar, and taking us through some of these changes. Appreciate it. Well, commodity markets, what's in focus? Manisha is standing by with that. Manisha.
Thank you for that, Prashant. Well, I'm looking at aluminum as prices because we've seen gain into this one as well. And as other asset classes have moved because of the decline in US dollar, well, that's one factor that seems to be supporting aluminum prices also. So we're back above 204 on your screens right now. And for the international markets in this week, we have seen prices gain up by 2.5% as well. Well, the support factor comes in from China, where we've seen imports gain up by 11.3% for the first 2 months of this year on a year-on-year basis. That has been supportive, telling you that the demand for aluminum and products seems to be coming back. And then the global primary output for the month of Feb gained up by 2.5%, which is lesser than as compared to last year and lesser than the last month as well, where we saw global primary output gain up by 3.3%. When you look at the global consumption for this year, that is estimated much higher at 4.7%. That clearly has been a supportive factor there. And when you look at the aluminum stocks at LME, they are near 17-year lows. The Shanghai aluminum stocks are at near 21-year lows. So that has been supportive. Also, inventories in the global markets last year fell by nearly 1 million tons as opposed to the previous year. So we are looking at lower inventories, lower production, but the consumption numbers do look supportive. There are supply shortages also reported in smelting industry in China and European Union. Power is still a concern. There's a power rationing also going on in China, and production because of pollution concerns there. That's an important statement coming in from Norsk Hydro, which says that 6 lakh tons of capacity still is at risk in Europe, and that would continue to add premium to prices. Fitch also has said that Russia, which is also a major producer of aluminum, could see a 3% decline in this year coming in from there as well. And when you look at the outlook going forward, while Fitch is still conservative at $2,600 per ton, Goldman Sachs very bullish, saying that 3,125 of an average in case of aluminum prices is what you could see this year.
Thanks very much for that. We'll take a very quick break here. Lata will get chatting with Seshagiri Rao of JSW Steel and Steel Demand Picture and how the EU's carbon taxes will impact Indian steel exports. Stay tuned. That conversation comes up next.